there's a lot going on in the world, economically, politically, geopolitically, socially, pick your area. And with some of these headwinds, we're now looking at the possibility of either entering into a recession in the near future or possibly currently being in one right now. With that, we wanted to share some timely information on recessions and how to make sure you have a successful investment experience going through a downturn and a possible recession. So with that, here are 3 topics that we wanted to touch on. First, a recession, or better yet, the fears of a recession, does not mean it's time to sell. Nobody has ever been able to consistently predict when a recession is going to occur, and more importantly, how the market's going to react in a recession. So let's look at how the recessions and the markets have fared through previous cycles. So this chart is showing a hypothetical $100 invested in the FAMA French US Total Market Research Index. The recessions are shown in green, and what's so cool about this chart is that it's giving you nearly a century of data on investing through recessions. There were a total of 15 recessions and 1 depression from 1926 to 2021, yet the long-term trend does look good. And even if we zoom in on some of these recessions, and because the stock market is a leading indicator, many times the markets have drawn down and then already started to recover before economists can make the call that we are actually in a recession, which is 2 quarters of negative GDP. So if we look at where we're at right now, that means we only need 1 more quarter of negative GDP to technically be in a recession currently. It's also important to note that many of the recession periods actually produced a positive return from the start of the recession to the end. I'll also mention that we have included this interactive PDF as an attachment for you to download because it's really interesting. You can click on each recession period, and that's going to give you the data points of that particular recession. It's going to show you the time frame, how long it lasted, unemployment, drawdown in the market, just some really interesting data. Now, I have picked a 5-year window in the 1980s to take a deeper look at on this particular video, just because it resonates well with where we're at right now, with inflation on the rise and rising rates as well. So like I mentioned, the first look is at the 1980 recession that lasted 6 months. And while there was a 12% drawdown in the market, the index started at $129 and ended at $131, which is a positive return from start to finish. The next recession started in 1981 and lasted 16 months, with inflation at 7.2%, with a drawdown in the markets of 15.9% from the peak. However, the index started the recession at 108 and ended at 118. So again, note that the market bottomed in each of these recessions well before it ended, and then each of the recessions produced a positive return for those that stuck with it. So the second topic I wanted to touch on is how the markets have recovered after drawdowns of varying sizes, which many times can occur during the recession in the short term. So since nobody can consistently time the markets, how do you continue to grow your assets in an environment like this? And this is where patience and sticking with your plan really does come into play, with the caveat that you have a good plan in place, of course. So the following chart is going to show you how the market has recovered on average since 1926 to 2021. The first graph here is going to show you the 1-year, 3-year, and 5-year returns after a 10% market decline has occurred. Now, as you can see, the 1-year is at 12.5%, again on average, after a 10% decline. The 3 years at 34.5%, and the 5-year is at 68.8%. And that's just after a 10% drawdown. Now let's jump to the right on the next graph, which is going to show you the same data, but after a 20% market decline, which puts us in official bear market territory and is a good representation of where we're currently at, as the S&P 500 hit the mark just recently, and then of course the NASDAQ has well surpassed that. As you can see, the numbers look even better with the 1-year return on average at 22.22%, but then look at the 5-year, it's up to 71.8%. Then the story just continues on with a 30% plus drawdown as you get similar results. So what's the story here? Investors in the markets have to deal with uncertainty and volatility that recessions and drawdowns will inevitably bring. But the evidence in the data is clear on this one, and that's just that sticking with your plan, rebalancing in these time frames is what's going to help you get out on the other end of this in good shape. So the third topic after seeing all this data is to frankly ignore the majority of the financial media, fearmongers, and market forecasters that are out there. Fear sells ads. It's what kind of prompts you to click on different articles or newsletters that are promising to save you from the impending economic doom. But it always tends to show up after the fact, as you can see, usually on the media where all these ads are popping up everywhere. So while fear may be good for their ratings, it's typically not good for your specific portfolio balance. So here's a great drawing from Carl Richards that just shows you that fear can lead you to sell at the wrong time, usually at the market low, and prevents you from getting reinvested as the market recovers. This is one of my favorite drawings. It just drives the point home. Plus, as we have witnessed with the COVID market crash and the many others, some of the largest returns can be found coming off the lows. So to end this one, I wanted to share some great quotes that I've written down throughout the years from some of the great investors that are out there. You're always hearing this information from us, so it's always just good to throw some of these out there to reinforce that. And it's just, some of them are just great. So we'll start throwing those up on the screen. So we'll start with one of the greats, Warren Buffett, who said, "Be fearful when others are greedy, and be greedy when others are fearful." Another one from Robert Arnott, "In investing, what is comfortable is rarely profitable." And then the next one we're going to look at from Sir John Templeton, "The 4 most dangerous words in investing are, 'This time it's different.'" And then I'm not sure who did this one, but it's a great one. "You've never been able to predict what the market will do next. This doesn't deter you from trying to predict what the market will do next." Always get a kick out of that one. And here's another great one. "Whenever some analyst seems to know what he or she is talking about, remember that pigs will fly before they'll ever release a full list of their past forecasts, including the bloopers." And then let's just wrap up with another great one from Warren Buffett. "The only value of stock forecasters is to make fortune tellers look good." So our goal with this, other than to beat you up with a bunch of charts and data, is to hopefully provide some background and context and knowledge about what's going on in the economy right now with recessions and how the markets have reacted previously. So you have the knowledge to know how to stick with your plan through this volatile environment. So again, we hope you found it helpful, and we'll see you next time.